Thanks to everyone who's joining. We're just going to give people a few seconds, and then we'll get started. But thank you for your time. Appreciate your engagement. Again, if you're just joining, thank you for joining. We'll be starting in just a few seconds. We're just giving people a few seconds to log on. Thank you for your time and look forward to your feedback and questions during this session. Great. It's a pleasure to welcome you. My name is Stephen Rothstein, and I am the Chief Program Officer at Ceres. And we appreciate your being here and the distinguished panel that we have. There is nothing more important than, if you can't manage something, you can only manage something by measuring it. And that we want to talk about that today with the insurance industry and the recent reports and initiatives. Next slide, please. um, we that at our at Ceres, we try to do this land acknowledgement that while we understand we're on a virtual platform, so people are all over the place, we want to begin by acknowledging the indigenous people of all lands that we're on today. We do this to reaffirm our commitment and responsibility to improving our own understanding of local indigenous peoples and their cultures. We acknowledge that our office headquarters is in Boston, and that's in the traditional land of the Massachusetts people. So thank you. And then it's really a special pleasure. I think I'm going to take down the slide to introduce our Massachusetts Commissioner, Michael Calge, is the insurance commissioner. He started not too long ago. He's already had a big impact. Prior to that, he's had extensive experience in the healthcare area. Commissioner, thank you for joining us. And more importantly, thank you for your leadership. Commissioner.
Good afternoon, everybody, and thank you to Steve and Jackie and everyone at Ceres for organizing today's webinar. And really, thank you for the work that you continue to do driving action in this really important area. It really is a distinct honor to be here. For those of you who have not met me, I'm Michael Caljo. I'm the Massachusetts Insurance Commissioner. Massachusetts is a member of the National Association of Insurance Commissioners, or NAIC, and you may know that the NAIC first adopted a climate risk disclosure survey back in 2010. Today, there are over 30 states, member states, and jurisdictions, including Massachusetts, that participate in this work. And that grouping represents about 85% of the US insurance market. Insurance is regulated at the state level. There is not a consistent federal set of regulation. And so it's important to note that state-based regulators, including the colleagues that preceded me in this role, have led on prioritizing climate disclosures, advancing risk management and measurement, and providing transparency for both regulators and the public. I do want to reflect back on a note that Steve said at the beginning of this session, which is if you can't measure it, you can't improve it, you can't track it, you don't understand the issue, and measurement is a really big part of the work that we all need to do. Climate risks affect all lines of insurance. While property risks often dominate the conversation, I am seeing growing impacts in health insurance and workers' compensation, including issues around the environment and environmental concerns like extreme heat, poor air quality, driving increased diagnoses, injuries, and the utilization of healthcare services. These risks aren't confined to Massachusetts or any one state. The TCFD aligned survey work alongside other tools, including the own risk solvency assessment or ORSA report filings that we get made at the Division of Insurance and other states get made, and other climate scenario analysis requirements are essential tools to state regulators and to the insurance companies themselves in our collective efforts to protect consumers and strengthen insurer resilience. I want to thank Ceres and Manifest Climate for preparing this analysis and for its companion report on metrics and targets. These insights help us deepen our understanding and sharpen our strategies. I look forward to today's discussion and, frankly, to the continuing vital dialogue that emerges today and throughout the years. Please know that in me and at the Mass Division of Insurance, you have an active and engaged partner in those efforts. And we pledge to do everything we can to be able to work productively and consistently and collaboratively with stakeholders and advancing really important climate change work. So with that, I'll turn it back to Steve and the team, but really just want to applaud you for the work that you're doing and look forward to today's dialogue.
Thank you, Commissioner, for those thoughtful comments, and particularly for noting the issues of extreme heat and all of those in addition to property damage. Thank you so much. Thank you. So now I'm going to turn this over to Jacqueline, I think, and she'll introduce the rest of our distinguished speakers. Jacqueline is the Director of Insurance, and she has a distinguished background. If I went through all of it, it would take the rest of the hour. So I'll just say it's really an honor, and I'm humbled to work with Jacqueline every day. Jacqueline, the floor is yours.
All right. Well, thank you, Commissioner, and thank you, Stephen. Good afternoon, everyone. I'm Jacqueline DeMedici Bruno, the Director of Insurance for Ceres, and welcome to today's webinar on climate disclosure for insurers. I'm delighted to be joined by this exceptional panel of experts that we have. So joining us today are Sharon Seelman, Director of Climate Strategy at Manulife, Ethan Aumann, Senior Director of Environmental Issues and Resiliency at the American Property and Casualty Insurers Association, Christine Bruni, Lead Climate Strategist at American Family Insurance, and of course, my colleague, Stephen Rothstein. Unfortunately, Dave Snyder, Vice President with EPSIA, he wanted to join us today, but was unable due to unforeseen circumstances. So welcome all, and thank you again for joining our discussion today. And before we dive into our presentations and panel, I just wanted to set the stage with some key findings from our latest research. Next slide, please. And for those of you who may be unfamiliar with Ceres, we're a nonprofit advocacy organization working to accelerate the transition to a cleaner, just, and more resilient economy. In our insurance work, we work directly with regulators, industry, and other stakeholders to address the financial impacts of climate risk in the insurance sector. Excuse me. Next slide. So to set the context, as the Commissioner mentioned, for over a decade, insurance regulators in the industry, they've been collaborating to develop a comprehensive climate disclosure guidelines. We had the first iteration begin in 2010, but they were looking at some way of making the reporting framework standardized. And in April of 2022, the NAIC officially endorsed the TCFD framework, or Task Force for Climate-Related Financial Disclosures, as the international standard. In this latest round of survey reporting, it again captured about 85% of the US insurance market across 29 participating states, over 500 insurer groups spanning all lines of business. Next slide. So if we contrast this with the first year of the TCFD-based survey, which had 15 states participating, capturing about 80% of the US marketplace, with just over 400 carrier groups reporting. So year over year, we have more states and more carriers. They're participating and providing this disclosure information. Next slide. In the TCFD framework, it focuses on 4 core pillars: governance, strategy, risk management, and metrics and targets, with 11 recommendations distributed within the pillars that asks carriers to describe how climate risks are identified, assessed, and managed across all levels of their organization. These are open-ended questions, as responses will differ based on company size, line of business, and so forth. Next slide. And why does this framework matter specifically for insurers? Because unlike other industries, insurers face climate risk from 2 distinct and critical angles. As risk carriers, they're dealing with physical risks, hurricanes, wildfire, flood, and so forth, more specifically on the P&C side. But as the commissioner mentioned, the materiality is becoming more and more apparent on the life and health lines of business. But these risks that directly affect their core underwriting and claims exposures. Simultaneously, as major institutional investors managing trillions in assets, they face transition risks that impact their investment portfolios as the economy shifts towards cleaner energy and sustainable practices. Next slide, please. So for the past 3 years, Ceres, in partnership with the California Department of Insurance, as the state that acts as the main aggregator of all surveys submitted, has been conducting comprehensive analysis of the NAIC's Climate Risk Disclosure Survey, which again utilizes that TCFD framework. And this research provides an objective assessment done in partnership with software company Manifest Climate, revealing how the industry is measuring and managing climate-related financial risks. And what we've found reveals both meaningful progress and significant opportunities for improvement in how insurers approach climate disclosure. Next slide. What brings us all here today is to discuss the 3rd year of this analysis, the results of which were published in our June 2025 progress report. Next slide. And here's the encouraging news. 99% of these carriers are reporting on risk management processes, how they're identifying and assessing climate-related risks. 97% are addressing strategy, how climate considerations integrate into their business planning. And 87% are tackling governance, establishing board oversight and management accountability for climate issues. And these are substantial improvements from our baseline measurements in the 1st year. However, only 29% are providing any information within the metrics and targets pillar. And without robust metrics and targets, everything else becomes aspirational rather than actionable. You can have the best governance structure and the most comprehensive strategy, but if you can't measure your progress, you can't manage that risk effectively. Next slide. And here we see the reporting trend year over year with that continued improvement in the first 3 pillars. Even adjusting for the increase in state and carrier participation over time, you can see the metrics and targets pillar. It's plateaued every year at just 29% of all reporting carriers providing any information within this pillar. Next slide. Our analysis also includes an interactive dashboard, and this is free to access and use for anybody. And it provides 6 different dashboard views and different filters you can set by company group, individual carrier, line of business, state of domicile, company size, and then, of course, by individual pillar or recommendation. There's a wealth of information out there, and we just wanted to make it accessible to all stakeholders. And here again, we see that 29% plateauing of the metrics and targets pillar, despite increased improvement in all of the reporting areas year after year. Because of this, we decided to also do a deep dive analysis into the metrics and targets reporting area to find where those barriers are, pull out best practices, and provide resources for the industry to really foster and support more robust metric and target reporting. Next slide. So this report, published in August of this year, conducts that deep dive analysis into the 45 insurer groups that did attempt full metric and target disclosure reporting. So they all provided information in all 3 recommendations of this pillar. So really reporting leaders in this space. Next slide, please. Our companion report, The Measurement Gap, reveals why this challenge is so persistent. When we break it down by emission scopes, the challenges become clearer. For scope 1 and 2 emissions, energy use in buildings, company vehicles, direct operations, these are under the company's direct control, yet we see minimal absolute target setting. These should actually be the easiest wins. And even more concerning is scope 3 or financed emissions, the carbon footprint of companies and projects that insurers invest in and underwrite. So this represents about 80 to 90% of most insurers' total climate footprint, yet we see near zero compliance for comprehensive scope 3 targets. But here's where optimism is warranted. Technical feasibility has been demonstrated by industry leaders. Some companies are successfully measuring and reporting comprehensive emissions data. The tools exist, the methodologies are proven, and the business case is clear. So what we need to encourage is sector-wide adoption and appropriate investment in measurement capabilities. Next slide. Our report also includes best practice examples from reporting leaders in this pillar, as well as examples of responses that are promising, but perhaps need more detail or information to be fully comprehensive. Our hope is that industry can use this as a resource to see what their peers are doing and build out their own metric and target frameworks. Next slide. We also include further resources and actions the industry can take over the immediate, near-term, and ongoing time horizons. Our goal is really just to support the industry and continue the momentum that they've already built. And it really is important to note that the US insurance market is ahead of all other financial sectors in climate disclosure reporting, and we applaud the industry's leadership in this space. Next slide. So this brings us to today's discussion, which brings together exactly the voices of industry leaders that we need to hear from. First, we'll have short, individual presentations by our panelists, followed by a panel discussion and hopefully time at the end for audience Q&A. I'm happy to turn it over now to Ethan Aumann, Senior Director of Environmental Issues and Resiliency at EPSIA. Ethan, the floor is yours.
Good afternoon. Thank you for the introduction. And on behalf of APCIA, I just want to thank Ceres for hosting this conversation. APCIA is the primary national trade association for property casualty insurers. So that is home, auto, and business insurance companies. And we represent about 2/3 of the total market and include companies really of all sizes and specialties. So APCIA has worked with Ceres through the development of the NEIC Climate Risk Disclosure Survey, and that collaboration has really been beneficial in making reporting more consistent and practical while keeping insurers' real-world challenges in view. My colleague, Dave Snyder, who unfortunately couldn't join us today, has been engaged in that work really for years. And Ceres' work in analyzing the progress and challenges of climate risk within the insurance sector really provides valuable insights, and we appreciate the opportunity to be a part of this dialogue today. So I want to spend just a minute laying the foundation for how property casualty insurers think about climate risk. And the property casualty insurance industry has really a long legacy of assessing and pricing risk and a track record of proactively addressing new challenges, from advocating for strong building codes to pioneering fire and electrical safety standards. And today, as climate change intensifies weather-related events, addressing these risks is not a new concept for our industry, but it's really a fundamental part of our operations. But climate disclosures are really just one part of the industry's preparation for climate-related risks. Extreme weather risk is integrated into the catastrophe models we use, informs underwriting practices, and is used in the development of new innovative products and strategies that help ultimately our customers build more resilient homes and businesses. So things like reinsurance layering, catastrophe bonds, and capital reserves also help cushion insurers' exposure to natural catastrophe and climate-related risks. I mentioned that the insurance industry's commitment to climate transparency and resilience is really evident in the data that Ceres' recent progress reports highlight. And as Jacqueline mentioned, the report talks about the significant progress the industry has made in key areas of climate risk disclosure, as well as the year-over-year improvement in all 4 of the TCFD pillars. It also highlights how property casualty insurers are acting as market signalers by adjusting their business operations in high-risk regions. So Jacqueline touched on some of this, but I'll talk about the property casualty insurer group specifically. The recent report that Ceres put out analyzed disclosures from 290 property casualty insurance groups. And for that cohort, there was nearly universal 99% of reporting in the TCFD risk management pillar. The strategy pillar had a reporting rate of 98%, and governance wasn't too far behind at 88%. So those pillars are really important for including elements related to identifying and assessing climate-related risks, the potential impact of climate-related risks and opportunities on business operations, and then the governance structures and processes for managing those risks and opportunities. The metrics and targets pillar, which is the focus of Ceres' most recent report, the measurement gap, and a large focus of this webinar today, had a disclosure rate of 33% for property casualty insurers. And here I just want to briefly address what I think are some of the main reasons for why reporting on that pillar is less universal. And I think we'll have a chance to maybe talk more about this later on. But I think the main reason why most property casualty insurers are not reporting under metrics and targets is that the data aren't yet quite there to do it credibly and consistently. Unlike manufacturing companies or other sectors, insurers don't produce a lot of direct emissions in the same way. We have relatively low scope 1 and scope 2 emissions, and our climate exposure is more tied to underwriting, investments, and policyholder behavior. So measuring and disclosing metrics like scope 3 emissions across those activities is still more experimental. We'd say that the data is still incomplete and inconsistent in cases. So there's also some confidentiality and litigation risks in this space. So setting the quantitative targets on underwriting or investment portfolios could be, in some cases, misinterpreted as restricting coverage for certain industries. And that raises competitive, regulatory, or legal concerns. Companies are just hesitant to publish targets that could later be challenged in court or used against them in litigation. So finally, the cost of building the systems to collect, validate, and audit climate metrics is still large. And I think that's especially a concern for some of our more mid-sized and regional insurance carriers. For some, the resources they find may be better directed toward risk mitigation that delivers more immediate benefits to policyholders. So while insurers support transparency, many are still needing the reliable data and protections or safeguards before they can credibly report on metrics and targets. And then just finally, in my last little minute here of time, I want to briefly mention that climate is certainly a growing issue and causing increasing losses to natural catastrophe disasters that we see across the US. But there are also, for insurance companies, several other factors that are driving insurance costs in recent years. And these include many more people moving into bigger and more expensive homes in higher risk areas, as well as significant inflation in building, material, and labor costs. So that impacts the cost that insurers have to pay for repairing and rebuilding properties. There's also concerns from a regulatory perspective, legal system abuse costs, which have really been escalating in recent years, and then inadequate building code adoption and enforcement that are contributing to insurance market disruption in regions that are exposed to climate disasters. So we ultimately think it's important to address the growing losses through improved resiliency by changing how and where we build and making our properties and homes more resilient to natural disasters. But ultimately, we also are committed to helping achieve a future where communities are safer in the face of a changing climate that we're seeing. So that's it.
All right. Well, Ethan, thank you so much for your insights, and we look forward to diving deeper in our discussion portion. Next up, we're going to hear from Christine Bruni, our representative with American Family Insurance. Christine?
Thanks, Jacqueline. Hi, everyone. Thank you for having me. I feel honored to be sitting on a panel with so many people I respect tremendously. So thanks again for having me. Again, my name is Christine Bruni. I'm the lead climate strategist at American Family Insurance. And for those of you who aren't as familiar with the AmFam brand, AmFam is a nearly 100-year-old Fortune 500 mutual company. We're headquartered where I sit here in Madison, Wisconsin. And we offer a broad range of insurance products, including auto, home, life, a small amount of commercial, and some farm and ranch coverage, but primarily personal lines coverage. The American Family Insurance brand is concentrated in a core 19 states, but we do have a 50-state footprint under subsidiary brands such as Homesite, Connect through our partnership with Costco, and Main Street America. As an enterprise, we continue to emphasize that we are customer-driven with a mission to inspire, protect, and restore dreams. And this mission really drives our approach to sustainability and climate risk management. So in my role as the company's climate strategist, I work across almost every function to integrate climate resilience into our business strategy, our operations, and then translate that work into our reporting. And at AmFam, we recognize that the identification, the assessment, the management of climate risks and opportunities is really a business imperative. We're very proud of our progress in climate risk reporting, and we're committed to transparency, and we're committed to continuous improvement. And I think that that's really key when we're looking at this type of reporting. And, hand in hand, it goes without saying that we are committed to supporting our customers and the communities in which we operate as we navigate these continuously evolving challenges together. So in terms of reporting, we have a long history of corporate responsibility reporting. We submitted annually to the NAIC Climate Risk Disclosure Survey, and we began voluntarily reporting and publishing our annual CDP response in 2021. And this was really kind of a pivotal change in the way we approached our reporting. It took a much more granular, standardized, and really a methodological approach to disclosure. And then in 2022, in compliance with NAIC requirements, we responded annually to their climate risk disclosure survey. And then we published our first TCFD report in 2022 when NAIC retired the disclosure survey and adopted the TCFD framework. And implementation of TCFD for AmFam was really a natural progression. We follow the 4 pillars of the TCFD framework, as Jacqueline had mentioned, governance, strategy, risk management, and metrics and targets. And we do this in order to ensure that our disclosures are accurate, they are, very importantly, forward-looking, and then, of course, aligned with regulatory expectations. So to spend just a couple minutes on each pillar and how AmFam approaches implementation of those pillars, our board of directors and our executive leadership team, they play a very active role in governing climate-related risks, both physical and transition. The management of climate risks and opportunities are governed by our N&G committee and our risk committee and multiple enterprise leadership councils at different levels of the organization. And this structure really ensures that climate oversight is embedded at both the board and executive leadership level, but also allows communication of critical climate information to flow in both directions, both upward and downwards between leadership and then relevant teams. And then as far as strategy integration goes, this is managed within my role, where we assess how climate-related risks and opportunities could impact our business over not just the short term that we see in insurance pricing cycles and operations, but also the medium and long term. And this really informs areas such as our growth strategy, philanthropic giving, and our investments. In terms of risk management, our enterprise climate risk assessment mirrors much of the same components as any other risk in our risk universe. We conduct an annual enterprise climate risk assessment in partnership with our enterprise risk management team. And then the outputs have become operationalized and loaded into all existing management systems and responses, and then can be translated into the ORSA filing or the RBC filing. And we do this by incorporating CAP models, scenario analysis, and exposure mapping to identify and quantify climate-related financial risks. And last, metrics and targets, which covers multiple areas across our risk universe. First, our risk exposure metrics. This includes outputs from our CAP models as well as climate conditioned CAP models. I think it was in 2024, we expanded our annual climate risk assessment to include value chain mapping of the identified risks and AALs and PMLs under different climate scenarios along differing time horizons. Operationally, our enterprise calculates its scope 1, 2, and 3 emissions under the GHG protocol, which really helps to provide insight into our operational footprint and also our footprint across our entire value chain. And this in turn informs decision making related to our climate strategy, transition risk exposure, and really our stakeholder expectations. And through lastly, our social investments arm, we continue to track energy transition and home hardening investments to promote one of the key pillars or objectives of our social investments vertical to promote home resilience in the United States. So with that, I'm honored to be a part of this conversation today. I look forward to learning from my fellow panelists and from you all. So thanks for having me.
All right. Thank you, Christine. And we definitely appreciate the perspective that you bring to this conversation. Next, we'll hear from Sharon Seelman, Director of Climate Strategy at Manulife. Sharon?
Thank you, Jacqueline, and thank you, Ethan and Christine. Good afternoon, everyone, and thank you, Ceres, for the opportunity to be here. It's truly an honor to be a part of this dialogue and very timely given everything that we see happening around the world. My name is Sharon Seelman. I am the Director for Climate Strategy at Manulife. And Manulife, for those who may not be very familiar with the name, we go by the name of or brand of John Hancock in the US, which may be a more familiar name for those on the call. We are a global financial services company and provide solutions from a life insurance perspective and health insurance perspective, but also from an asset management perspective and wealth management perspective as well. And I think because of that, I would say we're really in a unique position to really address climate risk through the perspective of long-term investment decisions and product innovation side of things. And we have come to understand over the years of doing this that climate risk really does pose a risk, not only to our business from an investment perspective or from a portfolio impact perspective, but also to come to understand that there is a public health implication and the livelihood of the communities where we operate, that climate risk really truly has an impact. And these risks, I think, come with its own respective challenges as well as opportunities. And that gives us the opportunity to make a difference by taking meaningful action in really mitigating climate change and accelerating the transition to a net zero future. As a life insurer, Manulife operates in a space where climate risk manifests a little bit differently than the P&C world. Our exposure, I would say, is more through the long-term investment side of things and the health-related impact side of things. But no less material, even though it's not visibly seen sometimes as often and prevalently. Since 2022, especially in the US market, we've seen that climate risk disclosures have really evolved from the regulatory perspective, from the voluntary framework to now being regulatory expectations. And the TCFD framework had really been the guiding principles where all these regulators are looking to converge on. And it's been adopted by several jurisdictions, not just in the US, but also globally in various regions where we operate in, and a majority of the insurance market as a whole. But from our perspective, we've been pretty early adopters of the TCFD framework. I would say since back in 2017, we've been disclosing on information within our sustainability disclosure suite with components associated with the TCFD framework. And we have started to look at it more with regulatory scrutiny coming into play as not just a compliance tool, but also as a strategic lens to our business in terms of how we operate and do things. And that has really helped us embed our climate strategy as a whole into not just one aspect of our business, but also in terms of our operations, our investments portfolio, as well as our products and services offerings. And the way it's structured within the organization itself, So climate governance kind of for us starts at the top. Our board oversees our climate strategy, and you have supporting executive teams that really drives the implementation through various business segments. And we have subject matter experts that sit within different parts of the organization that come together to support the efforts surrounding this. And we've started to also work more closely with our risks functions within the organization, starting from enterprise risk management, to think through how climate risk can be integrated further alongside of other principal risk types, and not seeing it as one particular type of risk, but also understanding that climate risk is a transverse risk across the organization that can impact various aspects such as our strategic risk, credit risk, market risk, and other principal risk types. So coming together to really change the narrative around how you define climate risk and the disclosures that support it, and the underlying frameworks and mechanisms that are at play to ensure that from an organizational perspective, the necessary due diligence and practices are in place to mitigate and manage climate risks associated with it. From a portfolio management perspective, within our investment portfolio specifically, I would say our exposures are systemic and they're a little bit more long duration in terms of the types of assets that we invest in. So even though we're not insuring physical assets, we are definitely investing in them. And that means our climate footprint is significantly tied to our investment portfolio associated with it. And measuring and managing those emissions is complex, but it's a very essential component of our risk management practice to ensure that we understand from a scope 3 finance emissions perspective what that footprint looks like, to ensure that we have proper efforts around making sure that they align with what we have stated in terms of our climate action plan and our commitments, and ensuring that from a target setting perspective that we are able to ensure that our efforts are focused on meeting those expectations as well, not just to our customers and our clients, but also our shareholders and our stakeholders. I would say as we look ahead in terms of what's to come, our focus really remains on translating ambition to action. And that means a few things. One is strengthening our data and measurement capabilities from an emissions perspective, but also other metrics perspective. So thinking about our carbon related assets, our sustainable investments, figuring out what are the metrics and targets that define how we ensure there is active progress on this topic, and making sure that the capabilities from an analytical component as well is enhanced throughout the organization and is a little bit more actionable to other segments across the organization to understand the impact that they have when it comes to these metrics and targets. Number two, I would say, is deepening more on that scenario analysis component. I know Christine referenced scenario analysis as well. Integrating scenario analysis, I think, has been an area of focus for us over the past couple of months, and something we'll continue to prioritize in the coming days as well, to ensure that it's used in proper decision-making processes to ensure we get that perspective in a holistic way across both the physical and transition risk lines, and also collaboration across the industry to really advance meaningful climate solutions. Peer-to-peer learning, I think I've come to find this has been very helpful in this topic, because there is a lot happening in terms of what's available from a data perspective, or what's going on out there in terms of like the mechanisms and methodologies associated with it. So that peer-to-peer collaboration and industry collaboration has been truly supportive in that sense. And I would say overall, just as my closing comment, how we see this topic of climate risk is that by embedding climate risk considerations and climate considerations as a whole into the core of our business, we can really support the stepping stones in building a more resilient financial system. And that means contributing to a healthier, more sustainable future for really the communities that we serve. Jacqueline, with that, I'll pass it back to you.
All right, great. Thank you, Sharon. So now we'll move into the more panel discussion portion of our webinar. And actually, Ethan, my first question is for you. So we've heard both about the progress and the challenges the industry has been facing. So from APCIA's perspective, as representative of the P&C industry, what do you see has driven that rapid improvement in TCFD adoption? And I know you touched on this a bit, but what are you seeing as the biggest implementation challenges your members face?
Yeah, well, thank you for that. First of all, I think I'd say that TCFD adoption has accelerated so much because, for one, insurers really recognize that climate risk is a component of financial risk and natural catastrophe risk, and that it really fits with the core expertise that insurers have in risk assessment and management. Um, Also, in terms of global consistency, and in this case, alignment with TCFD, um, that consistency helps avoid really a patchwork of different frameworks. So I think there's been a coalescence around the TCFD framework, and certainly helped along by actions like the NEIC's adoption in their climate disclosure survey that has really led to a coalescing around that particular framework. So in terms of, yeah, the biggest challenges that that insurance companies face, I think, insurers take climate disclosure very seriously, but at the same time, have to be realistic about some of the hurdles and the challenges, which I touched on earlier. So those include scope 3 emissions data gaps, and then confidentiality and litigation risk without kind of adequate safe harbors to protect insurance companies from potential litigation. And then the reporting systems. So, um, there are a limited number of third-party companies that work in the climate reporting and auditing space. And so, I've heard from our members that there are concerns about the availability and cost for those services given increasing demand. And so it's not really a reluctance necessarily. It's more about ensuring that the disclosures that insurance companies may put out there are accurate, meaningful, and do not create additional unintended risks. So those would be sort of the key challenges I think I would highlight.
Okay. Thank you so much for sharing that. So, and I know, within the climate risk space that most of the spotlight has kind of been on the P&C side of the insurance industry. But Sharon, as you stated, the life line of business has really done a lot of work in this area. And again, that materiality is being recognized more and more. So from your perspective, how is Manulife approaching, the measurement of investment portfolio emissions? And how do you see the life insurance sector's approach differing from the P&Cs? And I know you touched on this briefly as well. But it's really two, different perspectives trying to achieve the same reporting goals. So what has been your experience for that?
For sure. I think a bit of context, I think, Jacqueline. So I think from a life insurance side, the one thing to note is that our exposures are longer term and systemic risks. They're not tied to insurance assets, but they are tied to our investment portfolio that funds our liabilities of our life and health insurance products. And as a result of that, that means our scope 3 finance emissions represents a significant portfolio or significant part, I should say, not a portfolio, of our climate footprint. And from the Manulife side, we've committed to achieving a net zero finance emissions portfolio within our general account by 2050. And we have some interim science-based targets that we've set to help us make credible action in terms of decarbonization pathways to achieve that. So I would say from a measurement approach perspective, there is 3 particular things that we consider. One is through our measurement, we look at our absolute finance emissions measurements using the PCAF guidance to look at our portfolio view from an absolute emissions perspective. What does that look like for scope 3? Second is getting an understanding more through the sectoral intensities perspective, specifically on our power generation sector and exposure, to measure progress on our target for that asset class, specifically to evaluate from a sectoral intensities perspective, where does that emission story lie in those in that sector as a whole. And then the third mechanism we use from a scope 3 perspective is the portfolio temperature scoring approach. So we use issuer level emissions data to really assess the alignment with climate pathways, to understand what our portfolio temperature score looks like as a whole, to provide us with perspectives into how we should get to those credible decarbonization pathways to ensure we reach the net zero financed emissions by 2050 goal. From a mechanisms perspective, we also do rely on third-party tools and third-party data providers, and a lot of internal modeling to estimate some of the emissions across the not so easy to measure or harder to measure asset classes. And that's been really driven and supported by some of the regulatory expectations that have come into play in terms of enhancing disclosure or increasing disclosure expectations around our scope 3 emissions. And that's really guided us in making sure that we leverage the capabilities and the tools, not just internally, but also externally, to ensure that. And then I would say the last part of your question. So from the PNC side, there's more of the focus on underwriting on physical risks, whereas I would say from a life insurance perspective, there's almost a dual lens approach to consider, addressing the physical risk side within our real assets portfolio, and making sure that from a real assets perspective, that the impact of climate risk to the portfolio and the health of the individuals are taken into regard, but also from a transition risk perspective, given the long duration assets and investments, considering what that transition risk perspective could look like, or that should be about across credit or market risk, however it may play out, just understanding that perspective as well. And I would say our disclosures has evolved in its complexity as well, in terms of what we're doing and how we talk about what we're doing, and our measurement efforts across the organization, not just from the emissions perspective, but as a whole, when it comes to metrics evaluation, has started to be designed to really support more informed, forward-looking decision-making processes to help us again align to that broader picture of aligning with a net zero future.
Sharon, that's great. And again, part of the reason for doing this is because we believe insurers can learn so much from other insurers. So that what you've just said has a lot of great information. I just want to highlight 2 points. First, just to restate what the commissioner said earlier, is that this obviously affects workers' comp, it affects health, it affects life. And extreme heat is growing dramatically. Unfortunately, in Europe and other parts, we've seen literally tens of thousands of deaths already in this area. And the second point is that a lot of the data is inconclusive because it's being reported as a heart issue or a respiratory issue or others. So it may not be considered in the data as a climate issue. So it's just important to have that broader lens. Thanks again for the leadership, and Jacqueline, back to you.
All right, thank you, Stephen. So turning to Christine, this question is for you. So American Family is listed as in the deep dive analysis companion report as one of the organizations making efforts to report across all 3 metric and target recommendations. So can you just walk us through your journey? What did it take operationally to move from basic climate commitments to actual measurement and target setting? And where did you encounter the biggest obstacles? And then kind of along with that, what advice would you give to insurers that are just starting this journey?
Yeah, so thanks for that question. Our climate journey has been very rewarding, but has not come without challenges. Moving from basic climate commitments to really robust measurement and target setting really required a deep operational shift and strong relationship building across almost every part of our business, because climate really does touch everything in P&C insurance. Initially, our focus was on establishing these foundational commitments, publicly acknowledging the importance of climate risk and sustainability. But to truly embed our climate action into our business, we needed to move beyond these statements and start to really measure our impact and then activate it. And this meant really building internal capacity first. We invested in data systems, and we worked really cognizantly to foster a culture of accountability so that everyone across our organization understood how this is tied to our business, how their function contributes to kind of the macro and micro environments. And, we had some wins and losses along the way. We've successfully improved our data quality year over year, moving from spend-based to entity-specific emissions factors where possible for both our purchase goods and services and financed emissions, and increasing data quality and effectively communicating the methodology behind these calculations really strengthened our internal equity with, particularly with our procurement and investments folks who don't live and breathe emissions calculations and reporting. When specifically looking at financed emissions, we know that divestment is not the ultimate solution, and we must balance moral and fiduciary obligations. These aren't, check the box binary decisions that are made. And if you're acting as a fiduciary, you're going to take a comprehensive approach to assessing your investment portfolio's risk profile. And that means looking at all the types of risk that Sharon had mentioned: market, credit, liquidity, but also climate risk. So I think, my advice for other insurers just starting the journey is, start with a clear framework like TCFD and a proven methodology like the GHG protocol and PCAF for emissions reporting, and then build the buy-in across your organization early on. And then, we always say, don't let perfect be the enemy of good. So begin measuring what you can, even if it's not going to be perfect at first. And just, I had mentioned continuous improvement before. I did not like taking lean courses, but it is incredibly important to just focus on continuous improvement with your data quality and processes over time. But I'll say most importantly, and we've seen this with, we've kind of shifted our approach over the past 12 months, that you really have to make climate action a part of your company's DNA, not just a compliance exercise. Your climate strategy should be directly tied to your enterprise strategy. Stakeholders, both internal and external, they need to understand how your climate strategy ties to your enterprise strategy. If it doesn't align, you're going to lose stakeholder trust. For us, the journey, it's ongoing, but I think every step forward, it really just strengthens our company's resilience and ultimately our ability to serve our customers.
Great. Thank you for that. And it's really important to acknowledge, and what brings us here today is, having these discussions, in between different lines of business, seeing what your peers are doing, hearing about the journeys they've had, on their way to reporting excellence, and understanding that it's far more complex than just having a response to put down on the climate risk survey. So again, these are all really important perspectives to hear, and we appreciate this. So I'll ask just one more question, and this is open to everyone. I'd like everyone to just kind of popcorn in your answers as briefly as possible. So in this context of disclosure and the barriers identified, what would each of you want to see prioritized in the next 12 to 18 months? What makes the most sense to channel that energy? And Ethan, we can start with you on this one.
Sure. So, a lot can happen in 12 to 18 months. I think the landscape can shift rather abruptly, but I'd say there are a few things, maybe three things that I think should be prioritized. And one, and this touches on topics that I've already raised earlier, but is addressing safe harbors and confidentiality protections so that disclosures don't create additional litigation risk for companies. That shouldn't be the consequence of trying to do good and follow guidance and best practice in this area. Another thing that could be prioritized would be making sure to accommodate phased in reporting expectations to allow better data quality, especially Scope 3 emissions data, to allow that to develop over time. I know California, for instance, is in the process of developing the regulations to implement their climate disclosure law. And that's an instance where I think that phased in reporting should be considered. And then finally, I think a focus on common tools to help bring down the cost of reporting. That there's opportunities to standardize tools and reporting frameworks and resources to be able to help guide companies through the process and to develop common approaches there. Earlier this year, I'll mention that the International Sustainability Standards Board proposed some amendments to their climate-related disclosure standard to address some of the challenges that they've seen in this space. And that includes rethinking whether and how Scope 3 Category 15 financed emissions should be treated at this time. And so we welcome common sense kind of amendments given the current state of the science and as appropriate there. So I think ultimately if we get protections and better data quality and lower costs, that'll go a long way toward helping from the burden standpoint of reporting, and we can help build greater climate resilience.
Great. Sharon.
I think from my side, I would say the priority should really be about enabling insurance to move from disclosures to implementation. And it touches on some of the things that Ethan said as well, like focusing on tools and data, I think is a huge part of it, and guidance that can really help translate ambition to measurable action. And two areas, if I can particularly call out, one is I would say expanded scenario analysis, guidance, and capabilities. That would really support meaningful resilience testing across organizations. And I would say clear expectations and shared frameworks around this topic can really help insurers assess climate risk across different time horizons and different climate risk, physical or transition pathways in a way that you can understand the impact associated with it. And it's fairly sparse in terms of what's out there around this topic, and the ability to translate that back into business decision making. That's where the disconnect lies, I think. And the second one very much touches on what Christine had mentioned earlier, which is integrating climate into, core business processes, whether that be risk management, product development, how it may be. Disclosure is a great starting point in terms of how we're doing it, but the strategic integration is what really drives that long-term resilience perspective. So the next phase or evolution should really be about prioritizing execution, I would say.
Thank you. And last but not least, Christine.
Yeah, I think Sharon and Ethan really summed it up well. I think first, the continued focus on improving the quality and validity of climate data, especially on the physical risk exposure side. Integrating climate change into traditional CAT models is really an ongoing challenge with a lot of restrictions. I think it's important for us to find a way to more adequately quantify the future risk of a changing climate, especially in nearer term timeframes, over the next 0 to 10 years, not necessarily like 2100 when we're looking at climate scenario analysis. And this is probably a topic for another session, but I think climate and nature need to be measured together. They're not happening in silos. And nature loss directly impacts the physical risks of climate change, but we can save that for another conversation. And second, I think it's critical that organizations prioritize the integration of climate metrics into core business processes, which Sharon just mentioned, especially underwriting, risk management, product development. Climate risk should not be a standalone initiative. We need to continue to operationalize how we assess it. And then I'll just say, finally, I'd like to see the industry just continue to deepen its partnerships with stakeholders. This is a systemic issue. Not one type of insurance company, not one insurance company, not one regulator is going to solve this or have the answer or solution on their own. It is going to require partnerships with customers, communities, regulators, researchers, investors. It's going to be a multifaceted approach. So I think really continuing to build climate literacy across those stakeholder groups is critical, because there's a real moral hazard that our industry is very susceptible to. And we're seeing people move to high risk geographies and not understanding what their risk profile does to insurance. So how do we fill that climate literacy gap? So I think, if we can focus on these areas, we'll start to continue to accelerate progress. We can continue to strengthen resilience. And as an industry, we can tackle some of these, as I had said, systemic issues and ultimately deliver greater value to our customers.
Yeah, and I would just like to reiterate, that's something that we discuss all the time as well. It's not just the insurers, it's not just the regulators, but it really will take all stakeholders working together to move the insurance industry, into the new climate reality that we're all living in. So our time grows very short. I'm going to first thank you all for being here and turn it over to Stephen Rothstein for our closing.
Great. Yeah, thank you again. And I'm just quickly, we're going to send out the slides or send out the link to this. There's lots of resources we have available, and want to make sure we can be helpful. Next slide, please. If you have feedback on this webinar or on anything else we're doing, our emails are here. Jacqueline or myself, we really appreciate that feedback. Want to figure out how we can make this even more useful for the next time. Next slide, please. For those of you coming next week to Climate Week, we have lots of events, including an insurance panel, but we have panels on a variety of topics. Take a look at that. Please join us if your schedule allows. We know how frenetic Climate Week is, but it'd be great. Next slide, please, if you're able to join us. Then we have a big event in early October, Evening with Ceres at the John F. Kennedy Presidential Library. There's more information on this link. Again, we'd be humbled if any of you are able to join us. Next slide, please. We also, in some states, there's an effort to limit the ability to get information about these issues. And we respond to that as a freedom to invest. So, and then Ceres, there's lots of things here. So I think that's the last slide. Yeah. So we'd love to join us, be on our list. So thank you again for joining us. Thank you for Jacqueline. Thank you to the commissioner, and thanks to this distinguished panel. Together we can work together. Thanks, everybody.